This past month has been humbling for new investors. The S&P 500 is down over 5.31%, driving down portfolio values. Many individual stocks have seen even larger declines than the overall market. With these losses, it's important to remember that you shouldn't let the stock market prices determine your thoughts on an investment's quality. Ultimately, you should always look at the underlying business and what it produces. This is a fundamental lesson of investing outlined clearly by Warren Buffett in the following clip.
I look to the business to determine whether I've made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that.
There are plenty of companies right now whose stock price is going down, but the underlying business is doing great. I've been using this decline to buy more of my favorite stocks at a lower valuation. I'll discuss that in more detail later in the video. Nearly all of this market decline has been over the last 2 weeks. Why? The primary point seems to be right after the September Federal Reserve meeting. The main takeaway from the event is that rates will remain higher for longer. This burst the bubble of some market analysts who were predicting rate cuts in late 2023 and early 2024. So why does this matter? High interest rates increase the risk-free rate of return. It means you can buy US Treasury bills and other low-risk instruments to get a decent rate of return. This changes the incentives of investors, making them less likely to put capital towards risk assets. To varying degrees, stocks are considered risk assets since much of their future profits are unknown. This means less new money is likely to flow into the stock market during times of high rates. In a low rate environment, most of the cash will flow towards risk assets because that's the only place you can actually generate a return. As Warren Buffett says, interest rates are like gravity to valuation.
Interest rates are like gravity in valuations. I mean, if interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values. And we had that in the early 1980s. When the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances. Because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
This principle has been the major factor controlling the 2022 stock market crash and the subsequent 2023 market conditions. However, there are still plenty of great businesses trading at attractive prices. In this video, I'm going to share 4 stocks that I just bought to add to my long-term dividend growth stock portfolio. This is over $3.7 thousand in value, which is my largest month of buys in 2023. Also, I'll explain how I reinvested my $450 of new dividend income from that month. Finally, I'm going to update you on my overall portfolio and list some of the stocks I'll be targeting if the market continues to fall. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoyed the video. I post these portfolio updates every single month to reflect on my investing strategy. I hope that you find value and follow along. Throughout, I'll be using my stock research tool, which is available at dividenddata.com. Here you can track your investment portfolios and get custom analytics for the dividend-focused investor. On top of this, you gain access to deep financial research for over 7,500 stocks on the New York Stock Exchange Exchange, NASDAQ, and Amex. The tool shows every key financial metric displayed with detailed charts and tables, as well as calculated growth rates. If the software helps you identify just one slightly better investment, then it pays for itself. Right now there is a 14-day free trial, so I highly recommend that you become a member at dividenddata.com. Link in the description and pinned comment. Now let's dive into my portfolio. The current total value is $131,049. With $104,456 invested, my total return is 25.46%. This is down from the last update where I posted a 30% total return following the larger market decline. My top stock, Microsoft, is down over the past few months. I actually like that and hope it keeps going down so I can buy more at a cheaper price. Overall, I'm still up over 30% in that position. ExxonMobil's stock price actually went up over this past month, boosting my overall gain to 234%. The company is doing great and earnings are sure to trend upward again, as WTI crude oil prices have soared back up to over $90 a barrel, up 6% just this past month and up over 36% from the 2023 low. So my Exxon and Chevron stock actually rose in the month. However, many of my holdings went down by sizable amounts, whether it was Altria, Disney, Broadcom, Apple, T. Rowe, Visa, Texas Instruments, etc. It's important to remember that these are just on paper gains and losses. We have to look at the underlying business as investors. Many of my stocks are improving, growing earnings, paying dividends, increasing dividends, buying back shares, etc. Just recently, Altria grew their dividend by 4.3%. Microsoft grew its dividend by 10.3%. Texas Instruments raised its dividend by 4.8%. These increases, along with my new buys, which I will soon discuss, increased my portfolio's earning power. The projected dividend income for this account is now $3,923 annually, or $900 every quarter, $327 every month, $10.75 every day, or 45 cents every hour. All my current stocks pay quarterly dividends, giving me a 3-month rotation as shown here. My top payer is the Altria Group, ticker symbol MO. It makes up 40% of my annual dividend income. This is mainly due to its high yield. From reinvesting dividends, my yield on initial cost basis is now 9.78%. This will only continue to grow from the snowball effect of dividend reinvestment. In fact, this October, I'm about to get a massive dividend from Altria. I'll reinvest that dividend to acquire more shares, increasing my future income, and so on. This is what us dividend investors call the snowball effect. My portfolio just passed an important milestone. Since starting the account, I now have earned over $10,000 in total dividends. In fact, it's now $10,107. Last year, I earned $3,297, and so far in 2023, I have earned $2,594. This past month, I earned $457. This includes $51 from Broadcom, $25 from PepsiCo, $102 from T. Rowe Price, $68 from Microsoft, $31 from Chevron, $145 from ExxonMobil, $24 from Kroger, and $8.62 from Visa. These were all reinvested to acquire more shares, increasing my total investment for the month. Outside of dividend reinvestment, I bought $3,797 worth of stocks with new money added to the account. This was divided among 4 stocks, but mostly just in the top 2. First, I bought more Visa, ticker symbol V. I purchased 9 shares at an average cost of $232.80 per share, giving it a total cost of $2,095. The Visa buy will generate $16.20 in total dividends at a yield of 0.77%. Overall, my Visa holding has now risen to 4.95% of my current dividend portfolio value at $6,482. This purchase is an example of what I call a great company trading at a fair price. This is a concept Warren Buffett has often spoken about. I'll play a brief clip of him discussing that idea and then explain why I think Visa is a great company at a fair price.
In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving
the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. To sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean,
Visa is misunderstood by many. It's not actually a credit card company as many would think about it, as they don't bear any financial risk in terms of credit. That risk is borne by the financial institutions who choose to issue Visa cards. As a company, Visa operates the digital payment network by which all these transactions are processed. They make the bulk of their profits by charging a small fee on each transaction to the merchant. That is an incredibly scalable and high-margin business. On top of this, they have expanded into various value-added services. This deepens their relationship with financial institutions, merchants, fintech platforms, governments, and many others. They have great market share in digital payments, which is a fast-growing industry. The financials at Visa are stellar. The company's high earnings growth and shareholder focus have led to great total return for long-term investors. Revenue per share is growing at a 15% 10-year CAGR. Visa has 80% gross margins and 51% net margins. Free cash flow per share is growing at a 19.6% 10-year CAGR. Based on 2022 free cash flow and the current stock price, Visa is trading at 26.8 times free cash flow. Fiscal 2023 is almost over, showing even more growth from that point. This really is not that crazy of a valuation for such a high growth and dominant business. The free cash flow just keeps growing and capital expenditures stay low. Their business is so scalable and they use the cash flows to reward shareholders. Visa has a fast-growing dividend that is very sustainable. The 10-year CAGR of the dividend is 18.49%. The most recent dividend increase was a massive 20%. The dividend payout ratio based on free cash flow is 17% and 21% based on net income. This is so sustainable. They repurchase shares to an even higher degree, increasing the relative value of the shares you own. On their cash flow statement, you can see the money they use for stock repurchases and dividends every quarter. This is always within the range of free cash flow. The company is responsible with debt and has $18 billion in cash on hand. Visa is truly a great business trading at a fair price. I will continue to buy more at this price range. I would love it if I could build Visa into being one of my top holdings with Microsoft. Let me know in the comments if you want to see an updated Visa stock review video. Stock number 2 that I purchased is the Altria Group, ticker symbol MO. I bought 30 shares at an average cost of $42.56, giving me a total cost of $1,276. This will generate $117.60 in total dividends at a 9.21% yield. I've made so many videos about Altria, but I think it's a great deal right now. The business is rock solid with dominant market share and high margins. However, it is a very different archetype of a stock compared to Visa. Altria is a reliable, slow growth company trading at a price that I think is significantly undervalued. The business itself, though, is very strong. Earnings and free cash flow slowly grow year after year. In fact, the 10-year CAGR of free cash flow per share is 9.02%. Based on 2022 free cash flow and current prices, the stock is trading at 9.5 times free cash flow per share. Altria uses this cash flow to pay massive dividends and repurchase shares. The 5-year dividend CAGR is 4.14%. The most recent increase is 4.26%. The payout ratio based on free cash flow is 82%. Altria pays out most of their cash to shareholders via dividends. On top of this, they repurchase shares frequently. In my opinion, Altria's stock is poised for strong returns from this current level. I will continue buying more and reinvesting dividends. Stock number 3 is the Walt Disney Company, ticker symbol DIS. I bought 4 shares at a cost per share of $80.45, giving it a total cost of $321.79. The company has had their dividends suspended since the pandemic, but returning CEO Bob Iger announced an intention to reinstate, quote, a modest dividend by the end of 2023. 2023, so we will see soon. Now, my Disney investment is controversial, and buying so much in 2021 was one of my largest investing mistakes. However, I have kept the position as I see a clear path to high returns from here. I think we're near the bottom and financials are improving. They've cut costs dramatically and their streaming services are on pace to reach profitability in 2024. The main unknown is their planned selling of linear TV assets like ABC and their desires to bring on a partner for ESPN. Once this is all complete, I think Disney will be on a path for strong returns from here. It's more of a turnaround play, so I understand if some of you choose to avoid the stock. That said, I'm pretty confident it's a great value at current prices. Finally, stock number 4 is the T. Rowe Price Group, ticker symbol TROW. I bought one share at $103.82, netting $4.88 in dividends at a 4.7% yield. Long term, this has been a great dividend growth stock. Due to its high correlation with market conditions, the stock price and earnings are both down right now. However, the dividend payment and financial condition of the business is completely healthy. They have a rock-solid balance sheet with little debt. It's a solid business trading at what seems to be a cheap price. However, I'm being cautious with buying more as I already have a large stake and think it could fall slightly more from current levels. The company really won't see massive returns until we enter the next bull market. Then the value of assets under management will rise and they'll get more cash inflows. Until then, we're left waiting and reinvesting dividends, which I'm happy doing. I will add more if it continues to fall in price. So those are the 4 stocks I bought in this past month. I do have one more company that I am actively keeping my eye on. I'm planning on buying some more Microsoft stock if it gets below $300 again. I've made various videos outlining my bull case on the stock. Much of that was based on cloud being their growth driver. However, I think it's being underestimated the degree to which their Microsoft 365 suite will grow from their AI products. They announced their Copilot AI tool for enterprises will cost $30 per user per month. This is going to be massive in my opinion, at least over the long term. It launches on November 1st, and I think will have a significant impact on earnings over the next few years. I'm hoping the stock keeps falling so I can buy more at a fair price. Of course, this is all just my opinion, so be sure to do your own research before making any investment decisions. If you've enjoyed the video, leave a like, subscribe, and review on Spotify. You can sign up for dividenddata.com to track your portfolio and research stocks just like me. There you will gain access to the exact tool I use throughout the video. If the software helps you identify just one slightly better investment, then it pays for itself. Thanks for watching.